Good day, Gr12. We met once again. My name is Mr. Nyaile, the Departmental Head of Economic and Management Science in Grassland Secondary School. Today, I will be dealing with the topic again on paper 1, and the topic will be interpretation of the financial indicators. Now, before we can start, we need to highlight the most important things as far as the financial indicators are concerned. The first thing that we need to deal with is to understand why do we have to have the financial indicators in business. When we prepare the financial statement, there are users of the financial statement, which refer to the investors, people who invest in your company. We have the lenders, or people who borrow us the money, which refer to the financial institutions. Before they can be able to borrow you money, they need to know how is the performance of your business. Before the investors are able to invest in your company, they must also be able to know how is the performance of your business. And then SARS as well must also be interested to know on the financial indicators or on the financial statement of the company, because they want to know if you are actually paying the tax that is expected according to the Companies Act. So basically, the financial indicators helps those users to make their decisions about the company. Now, the financial indicators are divided into the following categories. The first one is going to be the one that deals with the liquidity of the business. Now, what is the liquidity of the business? The liquidity refers to the ability of the company to be able to pay its immediate debts or its short-term debts. And we have a 6 financial indicator that deals with liquidity. The first one is the current ratio, which determines if the business can be able to pay its current liabilities with its current asset that they have. Then the second one is the acid test ratio, which also helps the business to determine if they are able to pay their current liabilities with the current asset they have, but without the inventory. Then the third one will be the debtors collection schedule. This helps the business to determine how long does it take the business to collect money from the debtors. And according to the norm, it must be 30 days. Anything beyond that indicate a negative side of the business, because it must take the business only 30 days to collect money from the company. And then what is also acceptable here is when the ratio, at least it could say 2:1. What does it mean with 2:1? It simply means for every one liability, the business has 2 assets. So if this is the case, we are able to pay our current or immediate debts that we have as the company. Then number 4 is going to be the stock turnover rate. This ratio indicates how long does it take the business to sell the stock. The shorter the period, the better for the business. Because if we take long to sell the stock, this simply means now we might be able to lose the very same stock through damages, through expiry dates, or maybe through stolen stock. And then the 5th one is going to be the stock holding period. This period also should not be the longer period, because if we have to keep the stock for a longer period, it's going to cost us, because now we will have to pay for the storage cost where we are going to keep the stock. Secondly, the stock could also be in a possible way of being stolen. So it's better not to keep the stock for a longer period in the business so that the stock can be sold. Then the last ratio that goes with this, it will be the creditors payment period. This simply means how long does it take the business to pay the creditors. As we have just mentioned earlier, it should be between 60 to 90 days. We cannot take beyond this, because if we are unable to pay them within these days, especially after 90 days, we might be written off, we might be blacklisted. So we need to avoid that. At least it must be between 60 and 90 days. Anything beyond that is not good for the company. But still, anything less than 60 days, it's still not good for the company, because before we can pay our creditors, at least we need to be able to collect. So if we give us 60 days, it means we can be able to collect for 2 months, and then if the money is available, then we can be able to pay it over to our creditors. If it's not enough in 60 days, at least in 90 days, the money will still be enough for us to be able to pay our creditors. So these are the liquidity financial indicators that will determine if the company is able to pay its immediate debts or not. Then the second category of the financial indicators will be the gearing and risk. What do we mean by gearing and risk? We simply want to understand how will the company be financed. Is our company financed by its own capital, or is it financed by the borrowed capital? So the two financial indicators will be the debt equity ratio, which will specifically deal with the risk of the company. This one will tell us if the company has a low risk or if the company has a high risk. A high risk is when the company is depending on the borrowed capital, and then the low risk is when the company is depending on an own capital. So this means now, if the company is depending on its own capital, this means the company is able to have its own money. They don't have to pay any loan, they don't have to pay any interest. But if the company is relying on the borrowed capital, it simply means more money will go to the loan. The interest that we make, the profit that we make will have to go and pay the interest or that borrowed capital. So mean the company is at a high risk. Then the second ratio that deals with the gearing and risk will be ROTCE, which is going to be the return on total capital employed. This normally deals with gearing. We are only going to have a positive or a negative gearing in the company. We are going to have a positive gearing only if the percentage that we get from ROTCE is more than the interest rate. If it's more than the interest rate, then it means this company has a positive gearing. But if the interest percentage or the percentage interest that we get from return on total capital employed is less than the interest on loan, then this simply means now the company has a negative gearing. A positive gearing is when the company's return total on capital employed is more than the interest on loan. Then this company has a positive gearing. And the company will have a negative gearing only if the percentage of return on total capital employed is less than, in fact, yes, less than the interest on loan. So basically we compare the ROTCE ratio, which is return on total capital employed, with the interest on loan. So if ROTCE is more, positive gearing. If ROTCE is less, then negative gearing towards the company. Then the next category that we should also look at is the profitability of the company. Remember, the investors, before they can invest in your company, they must be able to know whether the company is profitable or not. So there are a number of ratios that we can also mention, but I'm just going to mention few of them that can also be able to tell you if the company is profitable or not. That could be the gross profit on sales, and we can also have the gross profit, operating profit on sales. Let me just correct it, operating profit on sales. This can also be able to determine how much are we going to have, and the gross profit on sales, the markup percentage on cost. They can also be able to determine how profitable the company is. So this is the profitability ratios that can be able to tell the company whether the company is more profitable or whether the company is not profitable. It can also be operating expenses on sales, just to determine whether you are making a profit or not. or how well do you control your operating expenses, how well do you control your gross profit, how well do you control or maintain your markup percentage. So the profitability ratio determines how best the company can be able to be profitable now and also in the future. So profitability is one of the financial indicators that the users can also use. And then we can also be able to use the returns. Remember, the shareholders, when they invest in the company, they are also interested on what they are going to get. So the financial indicator that could deal with it will be the ROT share, return on shareholders equity, meaning what they have invested in, how much are they going to get. So we can use ROSHE as one of the returns of the financial indicators. This is what the shareholders are going to get from what they have invested in the company. So basically we need to look at ROSHE so that we can be able to see if the shareholders are happy or if the shareholders are actually getting something from their investment. Now, the last one, we are going to deal with the dividends policy. We need to know in the company, how do we pay our shareholders? How much must be paid to the shareholders? How much is it going to be kept? Remember, the profit of the company belongs to three parties. The first part must go to the shareholders in the form of dividends. The other part must go to SARS in the form of income tax. Then the other part of the profit must be kept in the company in the form of retained income. Now, in the dividend policy, we need to indicate how much is going to be paid to the shareholders and how much is going to be kept for future growth. So in other words, if more profit is paid to the shareholders, this means we are trying to make them happy and we are trying to satisfy the shareholders. But if less profit is paid to the shareholders, let's say just a few percentage is paid to them, let's say 40% or 41 or 30 something percent or 52%, anything less than 60%. This means now the company has decided to keep more profit for future growth or for future expenses. If it happens that we don't make a profit next year, we can still be able to use the same money to pay the dividends of next year. That is the reason why the company would have to keep the money. If the company is unable to buy more asset again next year because they did not make enough profit this year, it means they can still use the money from the retained, the one that they kept. So the policy will indicate, how do we pay our dividends? Do we pay all of them to the shareholders or do we keep some for the company? If we pay more to the shareholders, we are trying to make them happy. If we pay less to the shareholders, it means we are trying to keep money so that it can be used for future reference. So these are the most important categories that you need to know and understand before you can start with any activity. Now that we have mentioned all the things that are necessary to be known, can we kindly go to the calculation so that we can start with our activity. Now this is going to be the question that we're going to be dealing with. This is the question of Limpopo, which was written last year in September 2020. It was a trial paper. So we are only going to do question 3 of this paper. This simply started as this way. The Gilbert Lewis owns shares in both companies. He wants to analyze both companies' financial results in order to improve his portfolio. This is a guy who invested in both companies, but he wants to make a decision of improving his portfolio. But his decision will be determined by the performance of both companies through the financial indicators. Now the first question says, comment on the liquidity of the two companies and explain how well they manage their working capital more efficiently. Remember, what did I say to you earlier? I said to you earlier that you need to know there are 6 liquidity ratios. We want to see if the company is able to pay or is able to manage its working capital more efficiently. Now let us look at the question. This is the question, and then this is our answer book where we need to be able to answer. The question said, comment on the liquidity of the two companies and explain which companies manage its working capital more efficiently. When you answer this question, first of all, you must start with a financial indicator. And then the question only wants, let's look at the mark. The mark is 6 marks. This simply means we need to look at least with a minimum of 2 financial indicators. Secondly, we need to look at the trend of the financial indicators. And then lastly, we need to comment. Then there will be 1 mark for financial indicator, 1 mark for trend, and 1 mark for commenting. So this is how we answer the question. Remember, what do we have under liquidity? We have 6 liquidity ratios. But you cannot just mention any liquidity ratio. It must depend on the question, which ones do you have. As we can see in the question, we have the current ratio as one of the liquidity ratios. We have the acid test ratio as one of the liquidity ratios. Then we don't have any other liquidity ratio that can be mentioned. So this means we have to pick those 2. The first one will be the current ratio. Then the second one will be the acid test ratio. What does that mean to you? This means now we have indicated the financial indicators. Now we need to show what? The trend. Remember, the question has said we need to compare the 2. The current ratio of Texas is 2,1:1, while Florida is 1,5:1. What does that mean? In the Texas, for one liability, they have 2 assets, but in Florida company, for one liability, they have 1,5 asset, meaning Texas is better than Florida as far as the current ratio is concerned. Now let us go to acid test ratio. Texas has 1,1:1, while Florida has 0,6:1. What also means, this means Texas can still be able to pay their current liabilities with the current asset without the trading stock, as we have just said earlier. But Florida, they are unable to pay their liabilities because their current asset without inventory is less than 1. So they are unable. Now, if we have to compare these 2 ratios, which company is actually managing its working capital more efficiently, then your answer is straightforward. Texas manage their working capital correctly or efficiently. Because why? Both ratios are on satisfactory level. They are both satisfied because they can be able to pay their current asset with their immediate liabilities. So this is the first thing that you must be able to know. What is important is that you must be able to code the financial indicators. You must be able to show the trend. And then lastly, you must be able to comment. What do you think? Which company manage its working capital more efficiently? Which company is able to pay its short-term or immediate debts immediately? Now the next question. The next question says, comment on the degree of risk and gearing of both companies and explain how this will influence your choice of the company. Remember, under gearing and risk, we just said we have 2 financial indicators. The first one will be the debt equity ratio. Then the second one will be the ROTCE. Remember, we still indicate the financial indicator. We still need to show the trend. And then lastly, we need to comment. Now let us see what is happening on the information. The debt equity ratio of taxes, we'll always start with taxes, is 0,6:1, and Florida is how much? Is 0,3:1. What does that mean? Remember, this side we have a loan, and this side we have shareholders' equity. This means this side we have a loan, this side is shareholders' equity. Non-current liability is to shareholders' equity. What does that mean? This side represents the amount of money that we borrowed. This side represents our own capital amount. So what does that mean? It means taxes is relying more on the own capital than the borrowed capital, which is the good thing for the company. It is a good thing for the company because they are able to get more money. So meaning, and then when we look at Florida, their own borrowed capital is 0,3 and their own capital is 1. So this means the taxes company is relying more on borrowed capital than their own capital. And then when we look at Florida, this means Florida, it simply means they have been able to rely on their own capital than the borrowed capital. It means they have more capital, or the company is financed with more own capital than the borrowed capital. But when we look at ROTCE, return on total capital employed, Florida has 15, let me start with Texas again. Texas has 11,6, which is less than the interest rate of 14%, while Florida has 15,5, which is more than the interest rate of 14%. So this also means that the Florida company also has what? The positive gearing, because the return on total capital employed is more than the interest on loan, while the Texas company has a negative gearing because the return on total capital employed is less than the interest rate. So ROTCE must be able to be compared with the interest on loan. But when we go back to the debt equity ratio, we are comparing the borrowed capital with the own capital. Florida rely more on own capital than a borrowed capital. But while Texas relies more on borrowed than own, because if we compare the two, they only have 0,3 liability, this one have 0,6. It means they have more liabilities than this one. So if we have to comment, we need to concentrate on the risk as well as on the gearing. So which company has a positive gearing and which company has a low risk? As we can see between the two, Florida is the company with a low risk and a positive gearing. It means this company has a low risk. At the same time, the company has a positive gearing. Why are they saying they have the low risk? Because the own capital is more than the borrowed capital. And then why are we saying they have the positive gearing? Is because the return on total capital employed is more than the interest rate. So this is how you can choose between the two companies to determine which one is at the low risk and which one is at the positive gearing. Now the next question is explain whether or not Gilbert should be satisfied with the return on investment. That is the question that we need to be able to answer. First of all, the financial indicator that deals with return is going to be ROCE, which is the return on shareholders' equity. Now we need to look at ROCE and tell us, what are we going to say? When we look at 2020, ROCE in the case of taxes is 28%, while last year it was 24%. This means it has increased. Remember, this is what comes to the shareholders. Whatever they get from the company has increased from 24% to 28%. But let's look at Florida. Florida is 16% this year, while last year it was a 14%. It means both companies have increased on their return on shareholders' equity. Now, if you have to comment, it means both companies are on the satisfactory level. Even though Texas has more than Florida, but both of them, their return on shareholders' equity has improved. So meaning it has exceeded or it has improved from last year. So you can still say both companies, ROCE has improved from last year, which is true. Last year it was 24% in Texas company, but this year is now 28%. In the case of Florida, last year it was 24%, now it's 16%. Even though the increase is slightly of 2%, but the point is it has improved, so the shareholders should be happy. So as Gilbert is the owner of both companies, he must be able to be happy with both companies because the return has improved from the one of last year up to the one of this year. So when we talk about the return on investment, remember to quote the ratio of return on total, return on shareholders' equity. Don't confuse return on shareholders' equity with return on total capital employed. This one, we use it for gearing, while ROCE, we use it for return on the investment of a shareholder or a particular owner in the very same company. Now the next question simply means now we need to do what? We need to do the calculation where we are going to calculate the dividend payout policy of both companies, indicate which company has adopted the better policy, and the possible reasons for that choice. Remember, the company has to decide whether they pay a lot of money or the more profit to the shareholders, or they have to decide whether they have to be able to do what? Whether they have to be able to keep money for the future. Now, how are we going to go about that? It means we need to do the calculations. And the calculations of dividend payout policy will start with taxes. And the ratio goes like this. That will be the dividends per share divided by earnings per share, which is equals to, we go to our information. Let's go to the information and check. What is dividends per share? Remember, we have to calculate for 2020 because we are going to comment on 2020 for both companies. But in this year, we are giving only 1 year, so there's no need for you to consider 2019 and 2020. Now let us concentrate, substitute whatever the values on the formula. In the case of the dividends per share, we are going to have 100 cents divided in the taxes. Let me correct it. In the taxes, it will be 75 cents divided by 143 multiplied by 100 over 1, which is going to give us almost 52%. It means only 52% will be paid to the shareholders. from the share of the profit. But when we go to the Florida, we do the same thing, dividends per share divided by earnings per share. We need to know how much they have paid. In the case of Florida, we are going to say 100 divided by 124 multiplied by 100 over 1. Then it means 81% of the profit was paid to the shareholders. If you have to reason, you can say if you decide to choose Florida, it means your explanation is going to be Florida, they pay out more than taxes. They paid out 81%, which is more than the taxes of 52%. Why did they pay more profit? Is because they wanted to satisfy the shareholders. It means Florida, their aim to pay 81% was to satisfy the shareholders. Hence, they paid more than what the taxes have paid. But if you were to choose taxes and comment on the dividend payout policy, you are going to say they paid 52%, which is less than 81% that has been paid by Florida. It means their decision was to keep more profit in order for the future growth, or maybe to use it in the future to pay for the necessary future expenses if the business does not have money. It means their decision or their choice, because remember we are talking about the choice. The choice or the reason to pay this is because they wanted to keep more money for future growth and development. The choice of Florida of paying 81%, it was because they wanted to satisfy the shareholders. They paid more profit towards the shareholders instead of keeping it into the company. While Texas paid less profit to the shareholders and decide to keep more money in order for the future profit. So this is how you are able to answer this question of the dividend payout policy. First of all, you must be able to calculate how much is paid to the shareholders in both companies. Then after calculating, you must be able to tell us the choice that was made by each company. This company decided to pay less profit to the shareholders because they kept money for future growth and development, while this company decided to pay more money towards the shareholders, or more profit towards the shareholders, just for one reason, because they wanted to keep the shareholders satisfied. So this is the most important thing that you should always remember. Now the next question says, refer to information B and C, indicate how many shares Gilbert must purchase in each company to maintain the percentage shareholding he had at the beginning of the year. Let us go to that information. C and B. Let us start with B. B is the share capital of the two companies. Share capital of the two companies. Let's look at those shares. Share capital of two companies. At the beginning of the year, the company had 420,000, which is Florida. During the year, they issued 117,000. Now, in total, how many shares were issued? 420,000 plus 117,000. This is what is happening at the end of the year. 537,000 shares were issued at the end. Now, in the case of Texas, at the beginning of the year, they had 140,000 shares. During the year, they issued 70,000 shares. The same during the year, they repurchased. Remember, according to the note, this is supposed to be subtracted. So how many shares were issued at the end? Then we will add them again. We would still say 140,000 plus 70,000 minus 35,000. It means at the end of the year, the Texas will have 175,000. Now remember, what was the question? And then in information C, this is the number of shares that Gilbert has in the Florida company and the number of shares that Gilbert has on the limited company. Now let us check here. This is what they had, he or she had at the beginning of the year. If this is what he or she had at the beginning of the year, this means we can be able to calculate the majority percentage that he had at the beginning of the year. So meaning, in Texas, we are going to say he had 214,200 shares. We are going to divide it by the shares at the beginning of the year of Texas, which is 140,000. In fact, in Texas, he had 84,000, let's correct it. And then the number of shares that he had is 140,000 at the beginning of the year. Now we multiply it by 100 over 1, which is going to give us 60%. It means in Texas, his shares, majority shares, was 60% at the beginning of the year. But now, he wants to remain the majority shareholder, even at the end of the year. Even at the end of the year, this shareholder still wants to remain the majority shareholder. How is he going to maintain that? How is he going to maintain that? It means we need to look at the information now to say how many shares he's supposed to buy. At the beginning of the year, the Texas has 420. Texas had 140,000. During the year, they issued 70,000 and they repurchased 30,000. It means Texas is left with 175,000. If he wants to remain a majority shareholder, we will multiply this by 51 over 100 to determine how many shares does he still need to purchase or have so that he can be able to become a majority shareholder. So we are going to say 175 multiply by 51 divided by 100. It means he must have 89,250 shares that he must be able to buy in order for him to be the majority. In fact, we need to be, because remember his shares at the beginning of the year was 60%. So we need to multiply this by 60. Let me call so that he can maintain his percentage. This means now, let me do it again. We are going to say 140 plus 70,000, which is going to be 175,000 in the Texas company. If we want to maintain his 60%, this means we must multiply this by 60 over 100, and then this will give us the calculation of 175,000 multiplied by 60 divided by 100. This means he must still be able to have 105 shares. But let's go back on what he currently has. Remember the question says he currently has 84,000 shares. Now for him to move from 84,000 to 105, we have to say 105,000 minus 84,000. This means he must now be able to buy at least 21,000 shares in order to maintain the majority shareholder. So he only needs to purchase 21,000 shares in the case of a Texas company. Therefore, we would say 105,000 minus 84,000. It means the additional shares that the Gilbert must be able to purchase in this company, it will have to be 21,000 shares in order to maintain his 60%. But now, let us go to Florida, the company of Florida. In the case of Florida, remember, he owns 214,000 shares. This is what he currently owns at the beginning, 200,000 to 214,200,000 at the beginning of the year. But according to the question, at the beginning of the year, the shares that were issued was 420. that were issued. Let me just do this so that it can be easier for you. So it means we are going to divide this by 420,000 to determine his majority shares. So we are going to say 214,200 divided by 420,000 multiplied by 100. It means his majority share was 51%. So he was still a majority shareholder. Now, during the year, the company bought or issued another shares of 117,000, meaning now the company is staying at 420,000 plus 117,000. The company is staying at 577,000. If he wants to become the majority shareholder, if he wants to maintain his percentage, then he will have to multiply this by 51 over 100 to see how many shares must he own in this particular company. So we are going to say 537,000 multiplied by 51 divided by 100. It means he must be able to have a number of 273,870 shares. Now, how much does he currently has? He has 2,200, and he must go to 273. So meaning the additional shares that he must be able to purchase will be the difference of minus, it will be 273,870 minus 214,000, which is going to be 59,670. This will represent the additional shares that Gilbert will have to buy in order to maintain his 51% ownership in the company. And then the last question that we have to do, it will be now calculate the amount that Gilbert will have to spend in order to maintain his percentage. Remember, in the Texas company, he must be able to buy at least 21,000 shares. Now let us go to the information to look at the market price of the Texas company shares. It means it's 16 rand. It means the value now will have to be 21,000 multiplied by 16. It means he will have to be able to pay 336,000. In the case of Florida, the additional shares that he must be able to buy is going to be 59,670 from the previous calculation. We multiply it by the market price. Let's go and check the market price. That is 8 rand. The market price is going to be 8 rand, the market price. So we'll multiply by 8 rand. This means now the value is going to be how much, which must be calculated. We are going to say now 59,670 multiplied by 8, which is going to give us 477,360. Now the total amount that he must be able to pay in both companies will be the one for Florida plus the one from Texas, meaning the total amount will have to be 813,360. Now, reason why do we have to pay it? Remember, they said provide a valid reason why Gilbert would pay this amount, because he wants to appear, or he wants to become a majority shareholder. That will be the reason why he will have to be able to buy them. Then the last question will be now to comment on the price of the price per share that Gilbert paid to these shares in each company and provide figures. Good people, if we have to compare or we have to comment on the price of the share, the most important thing is to look at the market price of every company and the net assets value per share. Value per share. We normally call it NAV. NAV. Value per share. Now, in the Texas, the market price is going to be
16 rand, while the net assets value, which is lower than the net assets value per share of 17 rand 50. The value of the share is 17 rand 50, but we are only going to purchase it for 16. In the market, it is only sold by 16 rand, which is not good for the company. And then in the case of Florida, the market price is going to be 8 rand, which is more than the net assets value per share, NAV, of 7 rand 20 cents. So meaning it is more with 80 cents. This means the value of the share in the company is 7 rand 20, but it is sold in the market with 8 rand, meaning the company is going to gain more for every shares that has been sold in the JSE. Remember, the shares are sold in the JSE. So this brings us to the end of the session. Remember, these are the calculations that are expected every time when you do the financial indicators to help the users of the financial statement to determine whether they can be able to invest in the company or whether they can be able to know the performance of every company. I thank you.